Welcome everyone to our webinar on the IASB's Exposure Draft, Climate-Related and Other Uncertainties in the Financial Statements. I'm Gustavo Olinda and I'm joined by my colleague Karen Robson. Today we will walk you through the key aspects of the IASB's proposals.
Hello everyone. We're excited to share insights on this exposure draft, which aims to improve reporting of climate-related and other uncertainties in financial statements.
Karen, could you start us off by providing an overview of the project?
Sure. The IASB started this project in March 2023 in response to strong demand from stakeholders during its third agenda consultation. The primary concern was that information about climate-related risks in financial statements was often insufficient or appeared to be inconsistent with information provided outside the financial statements, particularly in other general-purpose financial reports. This project aims to address these concerns by exploring targeted actions to improve the reporting of climate-related and other uncertainties in financial statements, including by helping to strengthen connections between financial statements and these other reports. Ultimately, this project is about providing better information for better decisions. While the project initially focused on climate-related risks, the IASB decided to generalize its scope to cover climate-related and other uncertainties. Gustavo, can you tell us why this decision was made?
There are several reasons for this. Firstly, the concerns we heard about insufficient and inconsistent information could also apply to other types of uncertainties. Generalizing the objective of this project to cover these other types of uncertainties is consistent with the principle-based nature of IFRS standards. Secondly, this approach ensures consistent treatment of various types of uncertainties, including those yet to emerge. And lastly, it acknowledges that the effects of climate-related uncertainties might not always be separable from other uncertainties.
The IASB's research on this project confirmed stakeholder concerns about insufficient or inconsistent information about climate-related risks in financial statements. It also revealed several key findings which are shown in this diagram. IFRS accounting standards are generally sufficient in requiring disclosure of the effects of climate-related risks in financial statements, but companies face some application challenges. The IASB therefore concluded that major changes to the standards are not needed, but more guidance might help companies to apply the standards. Some users need information beyond the scope of financial statements, which could be addressed through sustainability-related financial disclosures.
The IASB's research also shown that the evolving reporting landscape, particularly the developments in sustainability reporting, could inform the application of IFRS accounting standards. The IASB expects the application of these standards to improve as the process of companies preparing sustainability-related information matures. And lastly, our stakeholders emphasize the need for timely action to improve reporting of climate-related and other uncertainties in the financial statements.
Based on these research findings, the IASB decided to take several actions to improve reporting. These include improving the application of IFRS accounting standards through the illustrative examples proposed in the exposure draft, and by consulting the IFRS Interpretations Committee on the accounting for climate-related commitments. Raising awareness of existing requirements through improving the accessibility of educational materials and other initiatives, and strengthening connections between financial statements and sustainability-related financial disclosures. The rest of this presentation will focus on the first action I mentioned, the development of an exposure draft with illustrative examples. Gustavo, could you guide us through the approach to developing the illustrative examples?
Sure. In developing the examples, the IASB focused on requirements that are most relevant for reporting climate-related and other uncertainties, as well as those likely to address concerns about insufficient or inconsistent information. The examples primarily illustrate disclosure requirements. They demonstrate how companies make materiality judgments, disclose information about climate-related assumptions and estimation uncertainty, and disaggregate information based on climate-related risk characteristics. While the examples mainly focus on climate-related uncertainties to address stakeholders' concerns, the principles and requirements illustrated apply equally to other types of uncertainties. The IASB also chose to develop standalone examples with narrow fact patterns illustrating particular requirements, rather than examples with broader fact patterns that walk through the application of various accounting standards. This approach allows for more precise targeting of specific matters or requirements that give rise to stakeholders' concerns.
To address concerns about inconsistencies between financial statements and other general-purpose financial reports, some examples focus on demonstrating how to provide connected information across these reports. The examples also use concepts and terminology consistent with those used in IFRS sustainability disclosure standards, but do not limit connectivity considerations to companies that apply these standards. We also want to highlight that the IASB collaborated with ISSB members and technical staff throughout this project.
After considering various options, the IASB decided to propose including the examples as illustrative examples accompanying IFRS accounting standards. Illustrative examples accompanying the standards are easily accessible, useful for preparers, auditors, and regulators, and allow for greater flexibility in content and format compared to including them in the standards themselves. We note here that because they accompany but they are not part of IFRS accounting standards, the examples do not add or change the requirements in these standards. With that, we can move on to explaining the illustrative examples themselves. The examples are grouped into three main areas, as you can see on this slide. We will now walk you through examples 1 and 2.
Examples 1 and 2 illustrate how companies make materiality judgments about climate-related information, addressing a key concern raised by stakeholders. We think it's important to highlight here that these two examples also illustrate how the requirements in IFRS accounting standards enable companies to provide information in their financial statements that is connected to information it provides in other general-purpose financial reports. Example 1 shows a case where the materiality judgments a company makes results in additional disclosures. It involves a manufacturer exposed to climate-related transition risks that has developed a climate-related transition plan. The company discloses information about this plan in a general-purpose financial report outside the financial statements. In preparing its financial statements, the company determines that its transition plan has no effect on its financial position and financial performance. Despite this, the company concludes that additional disclosures about the effect or lack of effect of its transition plan on its financial position and financial performance would provide material information. This example emphasizes the importance of considering qualitative factors, such as disclosures made outside the financial statements, when making materiality judgments.
Example 2, on the other hand, illustrates a situation where no additional disclosures are needed in the financial statements. It features a service provided in an industry with limited exposure to climate-related transition risks. The company concludes that its greenhouse gas emission policy has no effect on its financial position and financial performance, and that the additional disclosures about the lack of effect of this policy would not provide material information in the financial statements. This example helps address concerns that considering qualitative factors could lead to excessive disclosures. Both examples 1 and 2 underscore the importance of considering both quantitative and qualitative factors in materiality assessments, and how a company's specific circumstances influence these judgments.
Examples 3 and 4 focus on the disclosure of assumptions, which is crucial for users to understand how climate-related and other uncertainties affect the recognition and measurement of assets and liabilities. Example 3 illustrates specific requirements in IAS 36 for disclosing information about assumptions used in impairment testing. It features a company with operations resulting in high greenhouse gas emissions and subject to emissions regulations in some jurisdictions. The company discloses key assumptions about future emission allowance costs used in determining a cash-generating unit's recoverable amount. This example shows how specific disclosure requirements in IFRS accounting standards can result in companies providing important information about climate-related assumptions.
Example 4 demonstrates the general requirements in IAS 1 for disclosing information about assumptions, even when specific disclosure requirements don't apply. It involves a company exposed to climate-related transition risks that might affect its ability to recover the carrying amounts of some non-current assets. The example clarifies that these requirements can apply to assumptions about long-term uncertainties, not just those that will be resolved within the next financial year. It also illustrates how a company determines what information to disclose about the assumptions to meet the objective of helping users understand management judgments about the future and other sources of estimation uncertainty.
Examples 5 and 6 cover additional scenarios where climate-related uncertainties might affect financial statement disclosures. Example 5 shows how companies might need to provide information about assumptions based on the overarching disclosure requirements in IAS 1, even when specific or general disclosure requirements don't apply. The example features a company operating in a jurisdiction where the government has announced regulation that could significantly affect the company's profitability and its ability to recover a deferred tax asset. This example illustrates that a company might need to disclose information about assumptions that don't have a significant risk of resulting in a material adjustment within the next financial year, but which could nonetheless provide material information to users.
Example 6 illustrates how companies might disclose information about the effects of climate-related risks on credit risk exposures and credit risk management practices, and how these relate to the recognition and measurement of expected credit losses. It involves a financial institution that considers climate-related risks in its credit risk management for certain loan portfolios. The example demonstrates how a company might determine what information about the effects of climate-related risks on credit risk is material and what specific information to disclose.
Our final two examples cover provisions and disaggregation of information. Example 7 demonstrates disclosures about uncertainties related to decommissioning and restoration provisions. It features a petrochemicals manufacturer with plant decommissioning and site restoration obligations. The example shows that even when the carrying amount of a provision is immaterial due to discounting, information about the underlying obligations can still be material, especially given the efforts to transition to a lower carbon economy.
Example 8 illustrates how applying the principles of aggregation and disaggregation in IFRS 18 might result in a company providing disaggregated information about property, plant, and equipment, based on the similar climate-related risk characteristics. It involves a company with two types of property, plant, and equipment with different vulnerabilities to climate-related transition risks. This example demonstrates how disaggregating information based on climate-related risk characteristics can provide material information to users of financial statements.
These 8 examples collectively show how existing IFRS accounting standards can result in companies providing useful information about climate-related and other uncertainties in their financial statements. Gustavo, what is the effective date and transition requirements that will apply if these proposed examples are finalized?
As these are illustrative examples accompanying IFRS accounting standards, they don't have a formal effective date or transition requirements. However, if the proposed illustrative examples are finalized, the IASB expects companies should be entitled to sufficient time to implement any changes resulting from these examples. It's also important to remember that materiality judgments should be reassessed at each reporting date, as changing circumstances may affect what information is considered material.
We've now come to the end of this webcast. We encourage you to send your comment letters with your views on these proposals. Your feedback is crucial in shaping the final guidance the IASB might issue on this topic. And remember, the deadline for comments is the 28th of November 2024.
We'd like to thank you all for watching and for your interest in this project. We hope these illustrative examples will help companies improve their disclosures about the effects of climate-related and other uncertainties in their financial statements. Improved disclosures will help investors to understand these effects and make connections with other information they received about a company, such as sustainability-related financial disclosures. Thank you.